Expense management is a critical aspect of running a successful healthcare organization. In today's competitive and highly regulated environment, providers must carefully monitor and control expenses to maintain financial viability. Expenses represent the outflow of resources used to generate revenue and deliver patient care services. By understanding the nature and behavior of expenses, managers can make informed decisions to optimize resource allocation and improve operational efficiency. To effectively manage expenses, it is essential to understand their composition. In hospitals, salaries and fringe benefits for staff typically account for the largest share of expenses, often exceeding 50% of total costs. This highlights the importance of workforce planning and productivity management. Supplies, including medical materials and pharmaceuticals, are the second largest expense category, followed by equipment and building expenses such as depreciation, maintenance, and utilities. Other expenses may include professional fees, insurance, and administrative costs. For physician practices, the expense composition is similar, with salaries being the most significant component. However, occupancy costs, such as rent or mortgage payments, tend to be a larger percentage of total expenses compared to hospitals. Supplies and other expenses like malpractice insurance and office equipment also play a notable role in physician practice expenses. When it comes to paying for expenses, there are two main approaches. The first is payment at the time the expense is incurred, which is less common in large organizations. This method is typically used for small, routine expenses paid through petty cash or corporate credit cards. The more prevalent approach is payment after the expense is incurred. In this case, the expense is recorded in the accounts payable ledger until the payment is processed. Monitoring the days in accounts payable, which measures the average time taken to pay an invoice, is a key performance indicator. Generally, organizations aim to pay within the agreed upon terms, often 30 days, to maintain good vendor relationships and avoid late payment penalties. To facilitate effective planning and control, healthcare organizations group expenses in various ways. One common approach is the use of cost centers, which are responsibility centers where managers have control of costs incurred. Examples of cost centers include nursing units, diagnostic departments, and support services like housekeeping and maintenance. By assigning expenses to cost centers, organizations can track and manage costs at a granular level, holding managers accountable for their areas of responsibilities. Cost centers can be further grouped into categories such as nursing services, ancillary services, general services, and support services. This allows for a hierarchical view of expenses, enabling senior management to monitor performance at a high level while still being able to drill down into specific areas as needed. Another way to group expenses is by diagnosis or procedure. Diagnosis-related groups, or DRGs, are a major diagnostic categories, or I should say, and major diagnostic categories, are used to classify patients based on clinical characteristics and the resources needed. By aligning expenses with these patient categories, organizations can better understand the costs associated with specific types of care and make informed decisions about resource allocation and reimbursement. Similarly, expenses can be grouped by procedural codes, such as current procedural technology or CPT codes to track costs specifically associated with medical interventions. This is particularly useful for outpatient services and can help organizations negotiate appropriate reimbursement rate with payers. Expenses can also be categorized by care settings such as inpatient or outpatient, or by service lines such as cardiology or orthopedics. This allows for a more comprehensive view of costs associated with different types of care delivery and can inform strategic decisions about service line expansion or contraction. Finally, expenses may be grouped by specific programs or initiatives, such as a community outreach project or a quality improvement initiative. These programs often have a dedicated funding source and require separate reporting to ensure accountability and demonstrate the impact of the investment. When discussing expenses, it is crucial to differentiate between expenses and costs. Expenses are expired costs that have been incurred and matched against current revenues. In other words, they represent the resources consumed in the process of generating revenue during a specific period of time. On the other hand, costs can be either expired or unexpired. Unexpired costs, such as the purchase of a long-term asset, will be allocated over future periods and matched against future revenues. Another important concept is that expenses represent an outflow of resources and therefore reduce the organization's value. That is why expense management is so critical. By controlling expenses, organizations can preserve their financial resources and reinvest in growth, innovation, and quality improvement initiatives. In conclusion, understanding the behavior and groupings of expenses is essential for effective financial management in healthcare organizations. By analyzing expense composition, monitoring disbursements, and categorizing expenses in meaningful ways, managers can gain valuable insights into the drivers of cost and identify opportunities for improvement. Effective expense management requires a collaborative effort across the organization, with managers at all levels taking ownership of their areas of responsibility. By fostering a culture of cost consciousness and continuous improvement, healthcare organizations can optimize their resources, enhance their operational efficiency, and ultimately deliver better value to patients and stakeholders. As we have seen throughout this lecture, expense management is a complex, multifaceted task and requires a deep understanding of the unique challenges and opportunities facing healthcare organizations. By mastering these concepts and techniques discussed today, you'll be well equipped to tackle this critical aspect of healthcare finance and make a positive impact on your organization's performance.